Unexpected surprise. Strong jobs growth and unemployment drop shake up the Fed's rate cut plans. The latest U.S. jobs report delivered a surprising twist. Hiring remained robust throughout June, and the unemployment rate unexpectedly dropped. Surprisingly, half of the new jobs were within the government sector, likely due to seasonal adjustments. After the report's release, the S&P 500 saw a moderate increase, and the yield on the 10-year Treasury ticked upward. Following the jobs report, the likelihood of the Federal Reserve cutting interest rates at the July 30th meeting dropped significantly. Three key factors might cause the Federal Reserve to consider a slower approach to rate cuts: the potential impact of Trump tariffs on inflation, a crackdown on immigration possibly affecting workforce participation, and the fiscal boost from the One Big Beautiful Bill Act. Entering the spotlight, tech stocks and trade negotiations. Cadence Design Systems and Synopsys led the charge among the S&P 500 in early Thursday trading. This happened after the Trump administration agreed to allow renewed sales of chip design software to Chinese customers, enhancing trade relations and allowing exports of rare earth magnets to the United States. A closer look, market reactions and economic sentiments. Samuel Toons, the chief US economist at Pantheon Macroeconomics, pointed out that private payroll growth, excluding healthcare and education sectors, was much lower than the past year's average, suggesting a weaker than expected performance. The slowdown in wage growth also indicated potential slack in the labour market, implying that the dip in the unemployment rate might not be as significant as it seems. But here's where it gets controversial. Some believe the economy could be producing fewer jobs due to tighter immigration policies, leading to uncertainties about interpreting these employment numbers. Eric Teal from Comerica Wealth Management offered a different view, arguing the shifts in immigration patterns will lead to a continued downward trend in the unemployment rate, possibly driving wages upwards. The market response from stocks to treasury yields. The S&P 500 saw a 0.5% rise in early Thursday trading as the jobs report hinted at economic resilience. The yield on a 10-year treasury reached 4.32%, though it eased slightly as market participants examined the underlying conditions of the report. Considering these figures, are we looking at a cooling labour market or just temporary noise? The drop in the unemployment rate can be attributed to a shrinking workforce. But is this a long-term trend or simply a momentary adjustment? Share your thoughts below or continue the discussion with us. Who's really creating jobs? June's job gains heavily favoured government employment, especially in education, contributing 73,000 new jobs. Healthcare and social assistance sectors accounted for 58,600 jobs, while leisure and hospitality gained 20,000 positions. However, manufacturing, wholesale, and temporary employment services saw declines. Wages and work hours, possible signs of cooling. The average hourly pay increased by just 0.2% in June, coming in below expected forecast of 0.3%. This reduced annual wage growth slightly from 3.9% to 3.7%. The slight reduction in the average workweek also hinted at a potentially softer labour market, undermining overall pay growth and possibly having implications for consumer spending. How did employers perform overall? The recent revisions for April and May showed stronger than initially reported numbers, with an average of 150,000 new jobs over the last 3 months. However, the diffusion index dropped below 50, highlighting that more industries are shedding jobs rather than adding them. A shift in Fed rate cut expectations. Before the report came out, markets were predicting a stronger chance of multiple Fed rate cuts this year. Now, those probabilities have shifted towards 50 basis points or less in rate cuts by year end, with only a 5% chance for a Fed rate cut this July. The key factor is the reduced job market slack, prompting the Fed to remain cautious. Could the story of tighter immigration policies reshape the labour market in unexpected ways? Let's discuss.